Hello and welcome. I'm Suyash Maheshwari and you are watching Last Tick here on News 9, where we bring to you the day's action on the Dalal Street. Now, Indian markets continue to stage a smart recovery for a second consecutive session on Friday. Nifty ended about 0.44% higher at 21,349 mark, whereas Sensex gained over 250 points, reclaiming the 71,000 level. Now, the recovery was even stronger in the broader markets as both mid-cap and the small-cap indices rallied nearly a percent or so. And this is after a 2% jump yesterday. Now, Nifty mid-cap 100, as you can see on your screen, ended about 0.73% higher, a touch below the 45,100 levels, whereas a small cap index, the Nifty small cap 100, ended over a percent higher at 14,846 marks, just about 55 points shy of its day's high of 14,903 sort of levels. Now, however, despite the recovery that we have seen in the last two sessions, all three indices ended lower on a weekly basis. Now, Nifty has in fact snapped a 7-week winning run to end the second last week of December down about a percent or so. Mid-cap 100 also snapped their 7-week winning run to end over a percent lower, and the small cap index ended their 3-week rally to end about a third of a percent lower in the second last week of December. Now, shifting focus to sectors, IT, realty, metal, pharma and auto stocks provided strength to the market, whereas the banking and the financial stocks capped the gains. Now, banking heavyweights such as your SBI, ICICI Bank, HDFC Bank and Axis Bank were the top drags on the headliners today. But to discuss this and more, let's also bring on board independent market expert Mr. Ambrish Balega. Hello, Mr. Balega. Thank you for joining us here on Last Tick. Now, we have rallied quite significantly since October. Nifty is up almost 2,500 points in that time frame. Do you think all the positive factors such as the expectation of political continuity, big rate cuts in US and India, are they now priced in? And what are some of the factors that will keep the markets moving from here on?
No, I think most of the positives have, already been factored in, because of which we saw this excellent move in the last couple of weeks. But then again, we need to know that whenever the correction comes, it can come without a warning, like what we saw a couple of days back, that suddenly you had the COVID fear coming up. We also heard about some raids on the brokerages and some operators. There was increase in margin. Then RBI had issued a notification, post that issue as far as the retail 50,000 loans and below is concerned. Beyond that, now they have started touching the AIFs, where these NBFCs and banks have invested. So, whenever adverse news comes, it normally comes without a warning. And we have seen the sort of cuts which have actually happened. And then anyway, this is the first time in the last so many weeks that we saw a cut like this. So typically, whenever these retail investors and the HNI investors have made money for a long time, a cut like this is normally seen as a discount sale, possibly an opportunity to buy at lower levels. And since people are sitting on liquidity, they have made good profits. Confidence level is high. So whenever a cut like this comes, they normally come in and start buying. And that's exactly what we have seen in the past few days. But again, if a cut is huge and it continues for about 2 or 3 days, that is when we need to see as to how these people react.
All right. Sir, now we have been constantly talking about froth building up in the broader markets, in the small cap and the mid cap indices, but they are not showing any signs of a slowdown. Do you expect this outperformance that we saw in 2023 to also continue in 2024?
It can continue for a while longer. See, whenever a froth is built up or whenever a bubble is created, again, I'm saying a bubble, especially in the mid cap and the small caps, and that too in various pockets. What we have seen that some of these stocks have become multi-baggers in just about the last 12 to 15 months. I think that is where the issue is. And it's very much possible that a bubble can become bigger. You can have more froth. But then when the cut comes, it can be savage. And we just saw a trailer I mean, see, like a 300-point fall looks big in numbers, but as a percentage, it's not too huge because we are currently about 21,000. But then just imagine, I mean, like a correction of say 500, 600 points in one day, and next day you have another 300, 400 points fall. I mean, a thousand fall in 2 days, I think can really trigger some sort of panic. And that is when all this confidence which you have got over the last so many months, I mean, just evaporates. I mean, we have seen this sort of a correction, this sort of a fall, where most of the retail investors have disappeared from the markets in the past. And this can happen again going ahead. And especially when, I mean, all of us are, I mean, shouting from the top of the roof that valuations are expensive and the
Right.
market is still going up. It's time to be a bit cautious, take some profits home.
All right. So, what should be the strategy stepping into 2024, sir?
I mean, I would say that step into 2024 with some amount of cash in your books. I mean, don't be fully invested. I mean, as of now, like I was saying earlier, we were decently in cash. We again got invested. Now, in the last a week, 10 days, we are again back into about 25% cash. And I mean, I would definitely recommend at least 15 to 20 to 25% of cash in your books when you get into 2024, because I mean, don't expect another year like what we saw, I mean, in 2023. I mean, it can't keep repeating itself. So I think one needs to be a bit careful at this point of time.
Interesting that you advise holding cash positions, because I think that's a virtue that's kind of lost on us in a market which chases momentum, is driving on leverage. Holding cash positions is something that we have lost, like investors have lost over time, isn't it?
Absolutely, because I mean, people see it's quite natural for one to get greedy. I mean, if say about 3 years back, if you'd asked someone as to what sort of returns do you expect from the market, one would have said possibly 16 to 18% per annum over like a longer period of time. You ask someone today on the street as to what is the sort of, I mean, what is the return he's expecting. I mean, they wouldn't be happy even with about 35, 40% return per annum. I mean, people are looking at doubling over the next month or 2 months. I mean, this is the sort of expectations which are there in the market. I mean, this can happen for a while, but it can't really happen, I mean, keep happening, I mean, to eternity. So at some point of time, we'll see that major correction.
And sir, are you at all surprised by the run that we have seen in PSUs? Because at the end of the day, their objective is national service, not shareholder service. And typically, investors turn to government enterprise only when everything else looks expensive.
No, but then see, yeah, you may say it is a service to the people, but then end of the day, when it's listed, I mean, they also have a service to the shareholders, and I think that is changing to a large extent. I mean, if you like the PSUs which you see today are not the PSUs which we had seen about 2 decades back. Things have changed quite a lot. Quite, I mean, I would, I mean, I would even go to the extent of saying that some of the PSUs I suppose, are more efficient than quite a few of our private companies in the sense the listed ones, which are not government companies. So you really can't call them the same old PSUs. And the view has changed, no doubt, as far as the investors are concerned. This was a rediscovery of the PSU stocks. But then I think even there, I think we have gone to an extreme as of now.
All right. And I mean, 2023 was definitely a year for PSU and realty stocks. But what are the sectors that could perhaps be in the limelight come 2024?
In 2024, one of the sectors which has been a laggard in this year, in 2023, could come into limelight. Like we have discussed this earlier also in your show. This is the IT sector, where we have seen some sort of a movement now, but then I think again we'll see a correction post the earnings. But then we will see this sector coming back into limelight possibly in the second half of the calendar year 2024. The other sector is specialty chemicals, where we have already seen a decent move in the past couple of weeks. And if you look at the last 2 quarters, I mean, the earnings, as far as the margins are concerned, they were better. Revenues should start really moving up from 2024 onwards, because the China plus one theme will actually play out. So specialty chemicals overall, I think, should do well. Automobiles, which have been doing well, I think will continue doing well, but maybe with a gap of a quarter or so, because at this point of time, most of them are, I think, fully priced, slightly overpriced. So we'll see some correction, and post that, it would be to look at the auto sector. Infrastructure, among that, I would say cement is one pocket which I think should do decently well in 2024. I mean, although they were market performers, but not really outperformed this year. I think next year we will see, I mean, the margins improving because what we have seen in cement in the past 3 years is that the volumes were going up, but the margins had not come into play. I think that will come to like in the next year.
And so speaking of the earnings season, the December quarter earnings season is upon us. What are your broader expectations from the December quarter?
No, I don't think there'll be huge surprises across any of the sectors because I think I mean, with the way the markets have moved up and the sort of earnings which you have seen in Q1 and Q2, I think the expectations would be quite high for Q3, and because of which I think meeting those expectations could be a bit difficult. So, I mean, I'll not be surprised if we see disappointments across.
And so any risk factors that we should keep in mind stepping into 2024?
I didn't get a question. I couldn't hear you clearly.
I meant to ask, what are the risk factors, in your opinion, for the next year that market needs to be prepared for?
I think one of the risk factors is possibly the rate cut, which we're again expecting in 2024. We have had now Fed saying that it will not happen in the first 2 quarters. It could be in the second half. I don't know whether RBI will cut before that, so maybe that could get delayed. That's one risk factor. The other risk factor is clearly the geopolitical risks which are there. I mean, you don't know as to what could come up next. But again, on the brighter side, we have seen two geopolitical issues in 2023. And that really didn't affect the markets too much. It just affected for a while. But the other big risk factor is the elections. I mean, as of now, I think most of the people in the market are feeling and assuming that the incumbent government will come back, possibly with a much better majority than what we had seen in 2019. But elections being elections, I mean, that uncertainty will be out. And
Right.
we will, I mean, surely have volatility just before the elections, maybe starting from March, April onwards. And in case, I mean, something goes wrong, I mean, that could be one of the biggest risk factors which are there because we've seen that, I mean, way back in 2004 when the India Shining thing was on. And I think everyone was very, very sure that, NDA would come back. But then, I mean, post the elections, we saw, I mean, 2 days of bottom circuit.
All right, sir. And what do you think of this situation that's playing out in the Red Sea? There are expectations that, if this crisis persists, there could be inflationary concerns because it would disrupt supply chains for industries relying on imported materials and potentially lead to higher prices.
Absolutely. I think we have seen that in the past also, that it can disrupt the supply chain. It can increase the value of the commodities getting imported. At the same time, you'll see the oil prices going up, which could be a negative for India. So I think it's developing. Let us wait for a while, maybe for a week, 10 days, and see as to how that develops. But if that continues, yes, I mean your freight rates, your container prices, everything will go up, and that can dent the profitability of Indian companies because we are decently dependent on a lot of imported raw materials.
And so before we let you go, if you have to leave our viewers with one thought for 2023 and to welcome 2024, what would that be, sir?
I mean, expect the unexpected. Yeah. When you're talking about the markets, because when we came into 2023, I don't think anyone really expected this sort of a run. And the first 3 months when I mean nothing too great, we thought it'll be more of a flat year, and then I mean it surprised everyone. So when you get into 2024, I mean expect the unexpected because I think most of the people are getting into 2024 with huge amount of confidence, saying that we'll see possibly the markets at I mean fresh highs. Fresh highs, yes, possible, but will the fresh highs remain for the whole year? I think that's a big question mark. So I would say again, repeat the same thing that have some liquidity when you get into 2024.
All right, that's Mr. Ambrish Balega for you, sir. Always a pleasure speaking to you. See you on the other side in 2024.
Thank you. And I'm wishing you all a very happy new year going ahead.
But with that, it's a wrap on this edition of Last Week. We'll get into a small break. but dive into the unparalleled financial wisdom with Money 9, the ultimate app to decode finance and real-time pocket cash. Get a hold of your financial journey starting now.
जानना है तो देखिए, समझना है तो सुनिए, सीखना है तो पूछिए, और कमाना है तो खरीदिए। जानकारी, सलाह और निवेश सब एक ही सुपर ऐप पर। पैसे का सवाल है तो जवाब है मनी 9। आजादी पैसे की। अभी डाउनलोड करें।